Let's just go back a little bit in history so I get some context of what I have to say. So during most of 2024, I was mostly bullish. Rather unusual proportion of my assets were long stocks throughout most of 2024. In December of 2024, I greatly reduced my long positions. I was still long, but I greatly reduced them. It was about 10% long US assets. And the reason was because not that I knew that Liberation Day tariffs were going to knock the heck out of the stock market. I just knew based on valuation metrics that I look at and based on the fact that the T-bill rate yielded higher than what you can get on an earnings yield. I just didn't think there was much risk reward wasn't there for me and my clients. So I greatly reduced my position. And that's why we were making money in the first quarter when the market was heading down. And then April 2nd came along. And because we had these Liberation Day tariffs that were so onerous, the sectors in my model, I have 5 inflation sectors that range from deflation, disinflation, stasis, to reflation, to hyperinflation. And each sector has their own stocks, bonds, commodities, currencies that you can choose from, back tested, that which works best in each condition. But they're not supposed to hop around like Mexican jumping beans. So I actually emailed you on April 2nd and said that my model got dramatically more defensive in 24 hours. And I got net short the market. And we did well up until April 9th. Now, April 9th, that was actually the day that Trump implemented his Liberation Day tariffs. And his Liberation Day lasted 12 hours. And he just suspended tariffs for 90 days. And immediately my model picked up on that because I have very highly stochastic components to the model. And then I went back to where I was in late December. And that is where we stand right now. You know, we've gotten back what we lost from his Liberation Week threat. And I now remain about 10% long US equities. I have 2% short position. Precious metals I have, both platinum and gold, and I have some foreign exposure. But most of my portfolio, 68% of it, is in T-bills, back where it was in late December. And that is because that's what not only what my model is telling me, but think about this. If I can get a higher yield sitting in very safe, ultra safe T-bills, short-term US debt, than I can on the earnings yield on stocks, that is the most prudent place for me and my clients' money to be at the moment. But I want to be very clear about this. What I just said does not preclude the fact that we still have a triumvirate of bubbles. I want to talk about what happened in that Liberation Week, why that was so devastating to the credit markets, and what my model is built to detect on. So I want to be able to do this. And I've been doing this 35 years. I've been licensed in this industry. Let's put it this way. Let's look at the tariffs and let's look at the threat of World War III that we had recently between either you could pick Ukraine, Russia, you could pick Iran and Israel, the United States. This model was so remarkably quiescent during that entire time. And I viscerally didn't understand it. But I'll stick to my model because I know that the people, the multi-billionaires, the despots and oligarchs that run this globe, this planet, they will profit if they know they're going to launch an atom bomb, a dirty bomb. They know when their banking assets are deteriorating to a point where they have to act, and they'll act on it. They'll buy gold, they'll sell copper, they'll buy T-bills and sell junk bonds. That's how it works. And if you know that, you can rest easy. Look at the valuations we have in the stock market right now. Look at the CAPE ratio at 37.8, I think it is. It's second highest in the history of the stock market. If you look at over 10 years, the stock market is supposed to return negative returns in a real sense. If you look at the total market cap of equities to GDP, it's back to 210%. Price to sales, 3. These are metrics like, oh my God, I got to be out of the stock market. But why am I in there? Because I know based on what those people are doing. So everybody has their narrative, everybody has their charts that are hard to read, and they can dazzle you with a million different things to look at. There's acronyms out there that help you invest. But if you look at the components that really matter, how these oligarchs are investing to profit from a recession, a credit market freeze, their reactions happen way in advance of what happens on the front page of the Wall Street Journal or on CNBC. If you look at the Trump's policies, border closures and deportations and the threat of tariffs, even though I had no idea they were going to be so onerous, announcement on April 2nd, that's not good for GDP growth. A shrinking labor force, I mean, that might make the unemployment rate go down because when your denominator drops, people looking for work as a percentage of your workforce. I mean, if everybody stopped looking for jobs, the unemployment rate can be zero. That doesn't mean you have a healthy economy. But I'm looking at what's going on with student loan. You have to pay your student loan back. There's some 9 million people now are delinquent on student loans. Yeah. FHA loans now, there's 10% FHA loans delinquents right now. And there's a lot of pressure on the middle class. My belief is it is not the rate of change, that first derivative, that first change in inflation that's really important. It's the second derivative, but more important than that, it's the level of prices. 60% of this country's inhabitants have less than $1,000 in the bank, according to a recent bank rate study. Mm-hmm. And there are studies out there that show close to 70% are living paycheck to paycheck. They have been wiped out from inflation. The fact that it's growing above 2% is an abomination. I mean, I am not on Trump's side that he should fire Powell for the fact he's not cutting rates. I think he should fire Powell for a myriad of other reasons. But to be honest with you, why are we still, after well over 4 years, above 2%? Why is Powell even contemplating cutting interest rates? He did cut interest rates in 2024, he cut them by 100 basis points. And the long end of the bond market said, you have to deal with America's inflation problem. We have an insolvency issue in this country. We've wiped out the middle class. They are hurting. I mean, having $1,000 of net worth, 60% of the people, that's terrible. And they're still losing 2% of their purchasing power on top of that every year. But in my mind, stable prices means 0% inflation. Stable prices does not mean 2% or 2.5%, and it doesn't mean that you should be happy missing your target to the north for over 4 years, and by your own admission won't get there until 6 years elapse. I think we're going to have a presidential puppet for a Fed chair. So I've labeled him, and I've said this for months now, the next Fed chair person will be an obsequious sycophant that will be willing to cut interest rates down to 1%. Trump said he wants the Fed funds rate to be slashed down to 1%. He wants it now. This is when unemployment was what? Well, 4.1%? By the way, that was a terrible unemployment report. I can't believe, blowout number. It was 74,000 private sector jobs. 62 or 64,000 of them were from people being hired to teach in June. Mm-hmm. Hours worked fell. The labor force is contracting. So it was a very anemic, weak report. It was not a strong report at all. But of course, if you just read the headlines from the mainstream financial media, you would hear, blowout numbers, crushing the headline expectation. But then you scratch a little bit below the surface. You go, oh boy, that was a pretty bad number. That wasn't very impressive at all. I see an anemic economy. I don't see Trump's policies, and I voted for him. He is far better than Kamala the communist would have ever been. Okay, I get it. But he's extending the TCJA, Tax Cut and Jobs Act. That is going to be pretty much a stasis of the rates that are in place right now. Now, if you look at some of this bill is spectacular, like the 100% expensing of capital goods. But if you look at tariffs, tariff rates are going from an average rate of 2% to about 15% right now. This is a fluid situation, but the best calculation that I could find is 15%. That's going to be a $600 billion increase in taxes per annum from his tax hikes, which are increasing regulations as well as increasing taxes. At the same time, he mostly extends the tax rate. So I don't see a huge fiscal boost here. And we're not getting a monetary boost because the Fed's hands are tied, partially because he's being bullied. And he's like, like an obdurate child who says, what, you want me to lower interest rates? Well, I'm not going to do it, And the other reason is because he just can't get to 2%, and that's his target. So maybe there's some semblance of sympathy he has for the middle class that he has, and I say this without reservation, he has helped destroy. And you say, well, why do you say, are you being hyperbolic, Mr. Pento? Why would you say that? Well, why was Jerome Powell buying mortgage-backed securities in early 2022, sending interest rates on mortgages much lower and causing home prices to go through the roof, so much so that they've now priced out the first-time home buyer? As a matter of fact, before I came on today, there was a headline that came on in the mainstream financial media. 1/3 of the top 100 markets are now seeing price reduction in their houses. So the home prices are now starting to roll over, and that's because they've been in a massive bubble. It's part of the triumvirate of bubbles. One is credit, one is real estate, and one is equities. I'm even more concerned about that top quintile, the top 20%, which is really keeping the economy going. They're relying on a quiescent credit market and a quiescent real estate market and a quiescent stock market. And I have my doubts that's going to continue. I'm not legally allowed to guarantee anything, but I can guarantee you this, that we haven't seen the last credit crisis in this country. I'm 100% convinced. And that's when you'll break that top cohort. When that comes crashing down, the whole thing, the whole house of cards comes crashing down.